episode of Mortgage Matters, every Wednesday with Team Adwar. Here's your host, Todd Adwar. There we are. Good morning. Good morning. Another one fabulous Monday morning, Wednesday morning. How are you, Todd?
Beautiful out today, right? Gorgeous before it gets too hot.
Getting the temperatures rising as they say.
It is in real estate too. It definitely is in real estate too. Well, good morning, everybody, and welcome to Mortgage Matters. Today we have as our guest Michael O'Connor, who's a reverse mortgage guru. We're going to introduce in a couple of minutes from Cross Country Mortgage, and it's going to be a great show. So we're glad that you could join us. And just like every week, I want to start off the show with an update on mortgage and real estate. So great news, rates are down and they're back in the sixes. Nationally, rates are at 6.99 on a 30-year conventional loan. But for those of you who are not putting down 20%, the better move is to go with FHA at 6.44%. A 15-year fix is now 6.40, and jumbo loans are still coming in over 7 at 7.23% nationally. There's a couple of very interesting things that came out this week. Real estate investors are back in the market big time. In fact, 1 out of every 5 homes in the United States in the first quarter of this year was purchased by an investor. Home prices smashed a new record. In fact, year over year, it's up 4.4% to $394,000. That's the median on home prices. Pending home sales, however, for the first quarter of this year are actually down 3.5%, or currently are down 3.5%. And listings, interestingly enough, are up 7.8%. So that could mean that there's a little drop, a slight drop in prices. But we have so many investors jumping in that I'm not sure that that's going to happen. Some other interesting news, 96% of the people who have mortgages in this country have a fixed rate, and 38.5% of all homeowners actually don't have a mortgage on their property. So let's get the show started, and let's get Michael O'Connor on and see what he's got to tell us about reverse mortgages. Hey, good morning, Mike. How are you?
Good morning, Todd. Good morning, Tim. Nice to see you guys. Thank you for having me here.
Hey, so did you hear that last comment that 38.5% of Americans don't have mortgages on their property, and they say most of that are seniors. So, what does that mean for your game?
For my game, it means opportunity, basically. What I see is a lot of homeowners that have a lot of untapped equity that they're sitting on, hundreds of thousands of dollars, that could be put to use to help them live a more comfortable, secure lifestyle.
So you specialize in just reverse mortgages. You've been doing it forever. And can you define what a reverse mortgage is for our folks? Because there's so many people that have different ideas of what it really is.
Exactly, Todd. Yeah, I think it's one of the most misunderstood mortgage products in the market. For sure, there's a lot of misconceptions that swirl around when it comes to reverse mortgages, and I hear all of them. But very basically, reverse mortgage is a program for homeowners who are 62 or older that allows them to tap into the equity that they've built up. Most of the time, they've been living in those homes for decades. Sometimes it's, 10, 20, 30, 40, 50 years they've been in this home. The home's appreciated greatly. So they're sitting on wealth. Wealth that's tied up. So the reverse mortgage allows them to unlock a percentage of that equity, put it to use however they choose, to pay bills, to live more comfortably, to travel, to buy other homes if necessary. But the difference essentially between a reverse mortgage and a conventional mortgage is, with a reverse mortgage, you have no obligation to make a monthly payment. You still own your home. You're still responsible for things like the taxes and the insurance and the upkeep on the house, which is true of any property. It's just common sense. But the reverse mortgage allows you to defer the repayment of whatever money you use for as long as you live in the home. Now, having said that, you do have the option to make payments if you want, but most people choose not to.
So with what's gone on in this country with home prices going up in the last 4 years, by 40 to 50% on average, depending on the state that you live in. What did that give the 65-year-old or 70-year-old person out there? Tell me what that did to them and the possibility of having a reverse.
Sure. So obviously home appreciation is good for homeowners. It's not always good for the guy who wants to buy a house and get into the market as a first timer, as the prices keep creeping higher. But for the homeowner, on paper, that shows wealth, right? If you're looking at a balance sheet, you got that home equity is a big part of, for many people, it could be all their wealth. They might not even have savings, but for most people, that represents a significant portion of their wealth. So the more wealth, the more that home value rises, the more that equity that they could put to use to pay their bills, to live more comfortably, to maintain a lifestyle, if you will. So home appreciation has been very good for everybody, but specifically for retirees.
So if you had a client and they're on a fixed pension, or maybe they're just on Social Security, how can you explain to them the difference in their lifestyle with a reverse mortgage versus making a payment every month?
Sure. So, a lot of people come to us because of cash flow for one reason or another. And what we try to address is there's what I call the 4 L's. And the 4 L's are longevity, lifestyle, liquidity, and legacy. So we'll have an in-depth conversation. We're going to peel that onion back pretty far, to get to what's going on in their life. What are they trying to accomplish? What goals do they still have? And we'll address each of those things. We talk about longevity. You look at any survey of retirees and what's one of their number one concerns, and that is, will I outlive my money? Am I going to be running out of money as I get older and older? And then you have the lifestyle. Am I going to be able to travel? Will I be able to go see my grandkids? Will I be able to go out to dinner when I want? Liquidity. What happens if you live in a home? There's going to be maintenance issues eventually. What if your burner breaks? What if your roof goes? Those can be tens of thousands of dollars. So you want that liquidity. You want to have access to cash. And then the legacy part of it we'll address as well, and that is, what are you going to leave for your kids or for your estate? So we go through and show them how putting some of that home equity to use can solve for a host of different issues that they're facing right now in retirement.
Is there a limit on how much a senior can get as far as a loan size?
Sure. So there's a couple of ways to answer that. There is, most of the reverse mortgages that are done in this country are done through a product known as a home equity conversion mortgage, or HECM, which is insured by the FHA. And that product's been around since the late 1980s. Okay. That program has a ceiling, and I don't want to mislead people. The ceiling is around $1,149,000, just to round it off. That doesn't mean that you're going to get the full $1,149,000. If you have a $1.5 million property, for example, what you will get is a percentage of that $1,149,000 based upon how old you are. If your house is worth $500,000, you're going to get a percentage of the $500,000. If your house is worth $800,000, we're going to give you a percentage, and that percentage is impacted by your age and your life expectancy. So a person, for example, who's in their 60s, let's say, might be able to access up to about 30% of the equity in their home. If they're in their 70s, that number might go up to 40%. 80s might go up to 50%. If you're 90s, it might go to 60%. And that's all because of the calculations are done based on life expectancy.
So we recently closed a loan together in New York, where the woman's home value was about $3 million, and she got $1 million.
So what she may have gotten, Todd, would be, remember I was talking about the federal program through the FHA, the HECM. Right. There are also what we call proprietary reverse mortgages. Yes. And those are typically for the home values that exceed $1 million, $1.5 million, up to $12 million we've done. And on those programs, you can borrow up to $4 million. So for example,
wow, a lot of money.
Yeah. We had a guy, he was a realtor. In fact, he was also an art collector and an art dealer. He owned a property out east on Long Island that was worth, I want to say, $10 to $12 million. And he owned it free and clear. But he got a reverse mortgage of $4 million on that property. And what did he do with the money? He went and bought another property.
Right. Okay. So there's a lot of things that they can do. A lot of times I'm asked, Well, how safe are these reverse mortgages? Years and years and years ago, there may have been a stigma with reverse mortgages.
That's for sure. Yeah. So there are a few bad apples that can give the industry a black eye. But what we're talking about here in terms of safety, it's probably the safest mortgage in the marketplace today. It is, first of all, it's overseen by the Federal Housing Administration, or FHA, which falls under the umbrella of the Department of Housing and Urban Development. They insure the reverse mortgage. What does that actually mean to a homeowner? What it means is a couple of things. First off, it guarantees that any money that they're entitled to receive will be paid to them, regardless of what happens to the lender. We all remember back in 2008 when the economy went over the cliff and the government had to step in and bail out the banks and the insurance companies and everybody else. Well, what if we had a replay of that? And if that did happen and you had a reverse mortgage with a certain lender, if that lender couldn't fulfill the obligation, federal government backs the loan and guarantees they would step up to the plate and make good on the money. Now, they also do something else that's very important. What if you got a reverse mortgage and you're 70 years old and you're blessed with longevity and you live to be 102? It could happen, right? So these loans are open.
It's happening all the time now.
Happening all the time. My mom was 100 years old. Okay. So what if you got a reverse mortgage, you used it over your lifetime, and you borrowed all the money you're eligible to receive, and then there was a housing crash? Again, I harken back to 2008. Home values went down 30%, right? Over those next couple of years. So what if your loan balance went up, your home value went down, and you tipped the scale to the point where you owed more than the value of the property? Well, the federal government's insurance says that this is a non-recourse loan. There is no personal liability to that homeowner, to their heirs, to pay back one penny more than whatever they can sell the house for. So if they're underwater, that insurance will protect them and make the lender whole, and it'll absolve the homeowner. And one other thought as far as safety goes, in order to get a reverse mortgage, we recommend the homeowners speak to their advisors, get educated, speak to your lender, get the facts. But even once you go through that process, you may decide, okay, reverse mortgage is something that I want to pursue. It is mandatory that you speak to a government-approved housing agency who is completely independent and impartial, who will explain the reverse mortgage to you without any axe to grind. They're not there to try to sell you anything one way or the other. Whether you get a reverse mortgage at the end of the day makes no difference to them. They just want to make sure you are fully informed and you're aware of certain things, that you are still the owner of the house. You do have responsibilities. You have to pay the taxes. You have to pay the insurance. And one day you have to pay this loan back. There were bad apples, as I said back in the day, who advertised this thing as like free money. And it's not free money. It is a loan just like any other mortgage. It accrues interest. And at some point you have to pay it back.
Now, if you're doing a mortgage for a couple, and 10 years later, one of the two passes away, do they have to sell the house, Mike?
So the answer to that is no. And typically when we do the loan for a couple, what we're going to find out first is who's entitled to that property. And if you don't own it jointly for one reason or another, we may recommend you do it jointly, but we're not going to require it. So if you are, for one reason or another, maybe it's a second marriage, and so you're not on the title. Okay. Right. Well, there are what we call a non-borrowing spouse, and that non-borrowing spouse is protected and can remain in the property should the borrowing spouse, who is entitled to the property, predecease them. They can remain in the property. Their end of the bargain is no different than it was for the borrower. Pay the taxes, pay the insurance, but one caveat: any funds from the reverse mortgage can no longer be advanced. So if they were still having payments sent to them, or they had funds in a credit line, they would not have access to that, which is why it's preferable if you can do it jointly as joint owners. If one predeceases the other, regardless of who outlives who, the payments would continue, the credit line would continue, as long as the homeowners, as long as one of them on title is still living there.
Can you explain why, when I get calls for reverse mortgages, I have to explain why the age is so important. Can you tell our viewers why age is the whole thing in this?
So the whole thing, the idea behind this is it's a way to age in place. I'm using air quotes there, right? So the idea was to allow homeowners to age in place. And so the calculations are done based on assumed life expectancy. So when we do a calculation, this is the same across the board, no matter who you're talking to, any lender in the country, we're all following the federal guidelines here. And we're going to put in your age, your property value, and the present interest rate. And then there's going to be a calculation that's done that will determine how much money can we safely lend you, so that if you live to your life expectancy and beyond, then we assume there will still be equity in the house, barring some unforeseen market crash or something like that.
Is it possible for you, for everybody watching, is it possible for you to tell us what percentage of the home they could borrow for a 70-year-old, a 75, and an 80-year-old, just those three
Yeah.
folks?
So a 70-year-old is probably going to get, if you're in your 70s, you're looking at anywhere from about 35 to 40% of the market value of your house. So if you've got a $500,000 house, maybe you can borrow 200,000 of that, right? And by the way, if there's an existing mortgage on the property, that mortgage will have to be paid off from the proceeds of the loan first, unless you have other resources to pay it off yourself. That's fine. But the reverse mortgage has to become the first and only mortgage or lien attached to the property. So a 70-year-old might get 40%, right? An 80-year-old, did you say?
Yes.
Okay, so if I'm 80, that number might go north of 40%. Now it could be 40 to 45 to up to 50%, depending where in the year 80s they are. Okay, so that
So if I have $1 million property, I have no mortgage on it, I'm 80 years old, I've gone through everything, I just have my Social Security, I barely, making ends meet, and my lifestyle's gone, crashed through the floor. The reverse mortgage is for them all day long.
All day long. And that's, I mean, I have a pipeline of 85-year-olds right now, pipeline full of them who are 85 years old, who own their home free and clear, who never thought they'd live this long. That's, that's their honest answer. Mike, I just never thought I'd be around this long. And they're usually a widow or a widower. So now their income has dropped because the spouse's income is no longer coming in. They're getting the higher of the two Social Securities, but maybe there was a pension attached to the spouse who passed. And so now they're trying to maintain a household on an income that's been cut in half. So they have all this equity, and we show them how we can convert that. And that $1 million property now gives them access to $450,000 cash that they probably couldn't spend in their lifetime, but it gives them the assurance, the peace of mind, and knowing that, hey, I can receive monthly payments from this to supplement my income, or I can use this as a credit line or a combination.
Can you explain the monthly payments, Mike?
Sure.
How would that work? Give me an example of how much money I could get every month.
Sure. So with the reverse mortgage, it's the homeowner who dictates to the lender how and when they want to receive their funds. You tell us how you want to structure it. We'll guide you. If you don't have a clue, we're gonna try to guide you and give you guidance as far as what's the best way to receive the funds. But basically what we do is we show you the amount of money you're eligible for. So we'll go back to the $1 million home and the 80-year-old homeowner who gets 400,000, let's say. That homeowner can say to me, Mike, you know what, we've looked at your budget. And you know what, after you pay your property taxes, your insurance, you put the food in the fridge and pay all your utilities, you're coming up $1,000 short a month. So you need some additional income each month. Well, we can structure that and give you an automatic payment of $1,000 that will hit your bank account, just like Social Security on the first of the month. And you can supplement your income that way, in addition to having money in reserve in the credit line that you could draw from for, say you want to buy a new car, say you want to take a trip, you have an unforeseen repair.
So if I'm worried about dad and mom and their lifestyle has gone through the floor because, they've lived longer than they were expecting, and they're living on social, but they have, they have this great house, I could make it so that they're getting their Social Security plus a check every month from the government. And if they have a big expenditure, they need a new roof, they need this, they could tap into the equity line and fix the roof so they're living the lifestyle they should be living. And I could recommend and say, Mom, Dad, you should be doing this.
100%. And the beauty of it is it doesn't put the burden on them, because what's the alternative? The alternative is maybe you want a home equity loan. Well, for that home equity loan, they're going to need a certain amount of income to qualify. And then they're going to need to make payments from that fixed income that they're living on. So it kind of defeats the purpose. And I have people who go down that path and they take the home equity loan because they think that's the right way to go. And then in 2 years, they're down the road and they've used the money and they need additional resources. And now they're coming back to get a reverse mortgage to pay off the equity loan, because the reverse mortgage will allow them to defer that repayment for as long as they live there. So our reverse mortgage is going to get paid back when A, they sell the property. So just like any other mortgage, or B, if it's they pass away, or if they're both pass away, if it's in the case of the husband and a wife. And in that case, just to clear up the most common misconception, we don't get the house when they die. Okay. I don't know where that started, but people think we take the house when the homeowner dies. The house passes to their estate. Their estate now owns a home that has a mortgage on it that's due and payable. Okay. So the estate has to make a choice. Are we keeping this house or are we selling it? 9 times out of 10, if the kids inherit the house, they want a for sale sign on the lawn as fast as possible, and they're going to sell that property And upon the sale, we're going to be repaid, and whatever is left is now divided amongst the heirs.
Right, just like it would if the parents had a mortgage.
No different.
You know, you said something interesting, Mike, that the credit line that they get actually increases every year. Can you explain how that happens? Because a regular credit line doesn't increase. It actually could go down if something changes. We saw that when the market crashed in 2008, 2009.
Yep. Those people who had set up a home equity loan, which financial advisors love to tell their clients, keep a home equity loan on the side just in case, right? Well, what happens when just in case actually happened back in that 2008, 2012 window, and people wanted to go draw from their equity line, but because their home value dropped 30, 40%, the bank froze the line, closed the line, and wouldn't give them access to the line.
Right.
So poof, no emergency money anymore. Reverse mortgage has a built-in growth factor on the funds that you're eligible for. Whatever rate you're being charged on the money you borrow, and today's rate is about 7.5%, that means that the money that you have not yet touched is going to grow by that same 7.5%. And let's be clear about that. You're not earning interest. Interest would be considered income and would be taxable. Money from a reverse mortgage is not income, not taxable. It's a loan. You're getting charged interest on it. You have to repay it. So it is not considered income. So if you're applying for any benefits or things like that, that might be based on your income, you do not list money that you receive from a reverse mortgage.
Great point.
Okay. So it doesn't impact that. It doesn't impact you if you're getting a break on your property taxes and so forth, because again, it's not income. It's money that you have access to that you can borrow, just like money on a credit card, for example. But the money in your credit line, say you had a $200,000 line of credit.
Yes.
And now you're just sitting there. You don't have an immediate need for it. And you let it sit there for the next year. Next year, you open up your statement and you look at it and you go, holy smokes, my $200,000 line of credit is now $215,000 because it grew by 7.5%. That's not going to happen on a traditional home equity loan.
Right. Now your grandson needs, $15,000 to buy a house, and boom, you
go.
have that. And
so here's one way that I tell clients sometimes to look at a reverse mortgage. Biggest expense most homeowners have, property taxes, right? Taxes where I am on Long Island, they're very expensive, Let's say your taxes are 15 grand a year. You have a $200,000 line of credit. You could annually go to your line of credit and just take the growth off the credit line, pay your property taxes, which means you're living in your house free and clear, basically, if you have no mortgage, right? And your credit line, you haven't put a dent in because the 200,000 is still there, and it's going to grow that 7.5% again next year. Now, one other thing to be clear about is that rate will fluctuate. So most reverse mortgages are a variable rate. They're tied on treasury bill rates. So if next year interest rates go down, let's say the Fed decides to step in and make some cuts, and rates drop from 7.5 to 6.5, then you're being charged 6.5 on what you borrow, and the money in the credit line would be growing at that same 6.5.
Hey, Mike, the new thing out there for the first time ever, co-op owners can possibly get a reverse mortgage. Can you tell us a little about that?
Yes, there is availability now for co-op owners to get a reverse mortgage. Now, I think earlier I was talking about the ways you can receive funds with a reverse mortgage, and that is you can have a credit line, you can receive monthly payments, you can get a lump sum, or you can do any combination of those three. The co-op program does not fall under the FHA guidelines. It's one of those proprietary reverse mortgages that I was talking about earlier that will go up to the $4 million number. Their terms are as follows. It's like a cash out refinance. In other words, we're going to give you a reverse mortgage against your co-op shares, but the money you receive, you're going to get in one lump sum.
Okay.
So it's great for someone who may want to pay off a loan on the co-op or just wants to have money to put in the bank or invest and use that to pay the maintenance charges or to live off and so on.
So it used to be, and I'm not sure if it is anymore, that if grandma or mom was having some credit issues, but had this big equity in their home, is that still possible for grandma if they're in foreclosure or they're having problems meeting their bills to get a mortgage?
It is still possible. Every one of these, Todd, is case by case. But what we're going to look at is what caused you to get into financial distress, right? Where did things go off the rails for you? And do you have a valid reason that we can address? And is this a one-time thing and we can get you back on track? And if it's not, if it's something where, the wheels just completely came off for one reason or another, right? What we can do in those situations is we can create an escrow for you where if you have debt, we can pay it off, or whether you have debt or not. But if your taxes and insurance need to be addressed, because our biggest concern is when we give you a reverse mortgage, we want to make sure it's a good fit. And
Gotcha.
it's going to keep you in that house, right? We don't want to give you a reverse mortgage and 3 years later you're off the track again and you can't manage your finances and now you're getting foreclosed on because you didn't pay your property taxes. So what we'll do for someone whose credit might have got banged up or fell behind on property taxes or maybe is in foreclosure is we'll create an escrow account using the funds from the reverse mortgage to pay the property taxes and insurance over their life expectancy. And therefore we can put that loan in place provided we have enough funds.
Because people who've had credit, seniors or super seniors, we could even call them now, since people are living a lot longer, they never even consider if they've had issues with their credit for whatever reason that, hey, I have an out with my home. But you're saying they do.
Yeah, they have it due. As long as we can give you enough money to fix the problem and keep you in that house, because that's the idea. We want to keep you in the house if that's what you want to do.
Now, Mike, you had a couple of interesting stories you were telling Tim and I about some people that you've closed recently. You want to share any of the client scenarios that?
Yeah, I mean, the clients run the gamut. I have professionals, doctors, lawyers, entertainers. I have the blue collar people. I have everything under the sun. I have millionaires. I've been in oceanfront houses that are worth millions. I've been in tiny little houses that were run down. So we see everything under the sun when it comes to reverse mortgages. What I love to see is the outcome. At the end of the day is how did these people use their funds and what did it do for them? So I worked recently with a woman here on Long Island, had an $800,000 property free and clear. She was a retired nurse. She had about $500,000 in the bank. Every year she'd spend a month for the winter down south in the warmer climate with a bunch of other nurses that she had worked with. So after doing that for about 10 years, she said, you know what, I'd really like to get my own place down here and spend a little more time. She had the resources, the $500,000 in her IRA and investments, everything, that she could have taken the money out of there and bought it cash. What she instead decided to do was get the reverse mortgage because that $500,000 is working for her, right? That's generating income, dividends, and so forth, and interest. And it's also a taxable event if she has to pull it out of her IRA. She instead turned to her home equity, pulled out enough equity out of the house to go buy the condo down in Florida free and clear. So now she spends 3 months instead of 1 month down in Florida, and she owns the property free and clear, and she still has no mortgage payments.
Yeah. And one of the things that gets in the way of these loans sometimes are the kids. So what do you say to kids who their parents are going to actually have a life again?
Yeah, so that's interesting. So it does happen. Thankfully, not as often as you would think. A lot more often, what I get, Todd, is the kids are actually encouraging mom and dad.
Okay, good.
You should be doing this. Now, I have had situations. I had one story that I can tell you where I sat at the kitchen table. This woman, you could see her nerves were shot. She had some health issues. She had debt issues, and she was under a lot of stress. As I sat there at the kitchen table, the walls in the house were rattling from the loudest rock and roll, heavy metal music you've ever heard. It was coming up from the basement. And as we were sitting there signing the papers, her grown 50-year-old son, shirtless, burst into the room and says, "Mom, what are you doing? What about my future?" And I looked at him and I just wanted to punch the guy in the nose, to be honest with you, because I was like, your future, your poor mom here is struggling away here to get by. And you're talking about your future while you're living in her basement. So it does happen, unfortunately, but for the most part, the kids are usually all on board, especially when you educate them. And that's what we're going to do. We're going to take time to educate you. And we're going to show you, here's mom, we're going to do a real analysis. What's your budget? What's coming in every month? What's going out? Why are we putting this in place? What's the real objective here? And the kids usually are going to buy in.
Okay.
I've one more quick one. We didn't touch on, are there any triggers or anything that happens with long-term care? Like say one in the couple slip and fall and then goes into long-term care or anything like that?
As long as we have one still living in the property, we're okay. So if I'm married and my wife unfortunately gets sick and has to go into long-term care, if we're both entitled to the property, I can still stay in the house. She can be in rehab or in long-term care if necessary. That's not a trigger for repayment. But if I'm the last surviving spouse, right? And now I have to go into long-term care. In the mortgage, the repayment clause is this. If you sell it, you transfer title basically. if you pass away or if you vacate the house for longer than 12 consecutive months. So think about long-term care. Now I'm no longer well enough to stay in my house. I've gone into a long-term care place. If you're not coming back after a year, it's time to figure out what we're doing with that house. But that would be a trigger if you're out of the house for a year.
Well,
very good. Well, thank
Michael,
you.
great. We enjoyed it. I think a lot of people learned a lot of things about it, and really how great reverse mortgages really are. And from 25, 30 years ago to now, it's just a totally different ballgame.
Absolutely. Yeah. Thank you very much, guys. I appreciate your time. Appreciate you having me today.
Have a
You
great
too.
day.
Thanks for the education.
You
Good
bet.
show.
Okay.
So next week, folks, we're going to have a credit specialist come on and talk to you about how to improve your credit. And just phenomenal. Somebody in the business 25 years, and she's going to come on and discuss credit, how to improve it quickly, and how to improve it over time. Because if you have a 650 score or below, it's not like the old days. 650 used to be an okay score. You want to be 720, 740, and really 760. And if you're sitting 760 and above, you're doing great. If you're not, watch this show. Have a great day.
See you next Wednesday at 11 a.m.
Absolutely.